Okay, I got what should be a better microphone, borrowed from Dr. Buttress. So let's see how this works. Hopefully a little bit better sound quality, a little less in the way of irritating side noises. Okay, we need to talk about dividends. And there are three basic types of dividends we'll be worrying about. Cash dividends, stock dividends, and property dividends. Now, dividends are referred to as non-reciprocal transfers to shareholders. They are entirely discretionary on the part of the board of directors. The board of directors is elected by the shareholders to do what's in the best interests of the shareholders, much like Congress is elected to represent our interests. And if the board of directors feels that dividends are not appropriate at this time, then they don't have to declare dividends. If you don't like that, then your job is to elect a new board of directors. The common types of dividends, again, first a cash dividend, where the shareholders receive a specified amount of cash for each share of stock held. Second, a stock dividend, where shareholders receive additional shares of whatever class of stock they own. And finally, property dividends, where shareholders receive some sort of non-cash asset as a dividend. Now, there are three dates of interest in the dividend cycle. The first date is the date of declaration. That's the date on which the board of directors formally declares that a dividend will be paid, and it's on that date that a legally binding liability is created. Next is what's referred to as the date of record. Stocks are bought and sold, publicly traded, 5 days a week, 52 weeks a year, with a few holidays off. And so if you declare a dividend on January 1st, the question is, who's going to get the dividend? And so they choose a specific set date and say whoever owns the stock on this date is going to receive the dividend. That's referred to as the date of record. If you are the shareholder of record on that date, you will receive the dividend. And finally, there's the date of payment, which is sort of self-explanatory. First, let's go ahead and talk about cash dividends. Cash dividends are far and away the most common type of dividend. So let's go ahead and assume that ABC Company has 1 million shares of $1 par value common stock outstanding. Sort of a generic statement of a dividend. On January 1st, 2001, the board declares a 15-cent per share cash dividend payable on March 1st, 01 to shareholders of record on February 1st, 01. On the date of declaration, they need to record either dividends declared or a debit to retained earnings. Now, dividends reduce retained earnings. You could simply directly debit retained earnings, but it's preferable, a little bit more elegant, to debit a dividends declared account. The dividends declared account is analogous to the drawing or withdrawals account for a sole proprietorship. By using this account, all of the dividends that are declared during the year will accumulate in the account, and then at the end of the accounting cycle, we'll go ahead and close that dividends declared account to retained earnings. On the credit side, we record a liability for dividends payable because, again, on the date of declaration, the corporation that's the date on which a legal liability is created to pay a dividend. On the date of record, there's no entry from an accounting standpoint. On the date of record, our shareholder services firm makes a list of who owns how many shares of stock, so we know who to send the checks to. On the date of payment, we simply pay off the liability like we would pay off any other liability. The next most common type of dividend is what's referred to as a stock dividend. There are two types of stock dividends. A small stock dividend is one that's less than 20%, roughly. A large stock dividend is one that's more than roughly 20%. That percentage is the percentage increase in shares. So if there are 100,000 shares of stock outstanding and there's a 10% stock dividend, that means you would issue an additional 10% or an additional 10,000 shares of stock. Now, stock dividends don't make the shareholder any better off, assuming efficient markets from your finance class. Let's assume that a firm is worth $100,000 and there are 100,000 shares of stock outstanding. Each share of stock is obviously worth $1, $100,000 in value spread over 100,000 shares. Now let's assume you own 10,000 shares, or 10%, worth $10,000. That means that you own 10% of the company. Now let's assume they declare and distribute a 25% stock dividend. The firm isn't any more valuable. They still have the same customers, the same products, the same assets, all the same things in terms of their economics are the same. The firm is still worth $100,000. But now, that $100,000 in value is divided over 125,000 shares, so each share is worth proportionally less, or 80 cents per share. You now own 12,500 shares. Your 10,000 that you originally had plus 25%, out of a total of 125,000, so you still own 10% of the firm. You're no better off than you were before. The total value of your holdings is unchanged. It's simply being spread over a larger number of shares. So you have more shares, each of which is worth proportionally less. Now, why would firms issue stock dividends then? The two main reasons, sort of the good reason, I guess, is to lower the stock price. As we saw in this example, the stock price fell from $1 down to 80 cents. Now, if your stock price is in the $3 or $4 or $500 range, that's going to intimidate or scare away a lot of small retail investors. If you want to buy stocks in lots of 100 shares, and your stock price is $300 per share, somebody's got to plunk down $30,000 to buy 100 shares of stock. So to make it more marketable, you might have a stock dividend, increasing the number of shares, decreasing the value per share. A second reason would be to essentially fool naive shareholders. If you are a shareholder and you get a letter in the mail saying, we've just given you an extra 2,500 shares of stock, if you don't think it through, you'll think, hey, this is great. I now own more shares of stock. They sent me something of real economic value. What might not be realized by many people is, although you've received additional shares, the value per share of all the stock you already held has fallen an equal and offsetting amount. So you're not any better off than you were previously. And sometimes firms, they very proudly tout that we've paid quarterly dividends every year for every quarter for the past 50 years, and then one quarter rolls around and they simply don't have any cash and they can't pay a cash dividend. What can they do? Well, they can issue a stock dividend, and then technically they can still say we've declared dividends every quarter for the past 50 years, even though it wasn't actually a cash dividend. Large stock dividends. Let's do an example of a large stock dividend first, because they're much simpler to account for. Again, stock dividend is a non-cash transaction. So the first question that crosses our mind is, A, how many shares are we going to distribute? And B, what value should we assign to this transaction? For a small stock dividend, we use the market value of the stock issued. For a large stock dividend, we use the par value of the stock issued. So again, let's do a large stock example. Let's assume a firm has 500,000 shares of $1 par value common stock outstanding. On January 1st, they declare a 50% stock dividend payable on March 1st to shareholders of record on February 1st, and the stock price was $7 per share. First, we need to figure out how many shares are going to be issued. There are 500,000 shares outstanding. We're going to issue an additional 50%, so we're going to issue 250,000 shares. And since this is a large stock dividend, it's going to be valued at the par value of $1 per share, $250,000. On the date of declaration, we debit that dividends declared account, or retained earnings as a poor substitute, for $250,000, and credits common stock dividend distributable. Now that common stock dividend distributable account is an equity account, and it essentially represents stock that is soon to be issued, or pending, if you will, and it's recorded at par value. So on the date of distribution, we'll simply take away the common stock dividend distributable and replace it with common stock, both at par value. So it's very neat, removing the sort of pending common stock, replacing it with the actual common stock. Now, a note about account titles. Basically, dividends payable is reserved for cash dividends. Common stock dividend distributable is reserved for stock dividends. When we get to property dividends, it's traditional simply to call them dividends distributable. Again, dividends payable sort of implies a cash dividend, so we'll just say dividends distributable to represent a non-cash asset distribution. Okay, so let's go ahead and take a look at an example of a small stock dividend. Let's go and assume that a firm has 500,000 shares of $1 par value common stock outstanding, and that on January 1st they declare a 10% stock dividend payable on March 1st to shareholders of record on February 1st. And let's assume the stock price is $7 per share. Now we have to figure out the number of shares to be issued, and we're going to be issuing 500,000 times 10% or 50,000 shares, valued at $7 each, That's $350,000. So at the date of declaration, we're going to go ahead and debit that dividends declared account for the value assigned to the transaction. We're going to credit common stock dividend distributable at the par value of the shares to be issued, 50,000 shares at $1 apiece. The excess goes into plain old paid-in capital in excess of par. No mention there that it's from a stock dividend. We simply record the additional paid-in capital in excess of par. Again, the common stock dividend distributable is an equity account representing stock that is on the verge of being issued. At the date of distribution, we take away the common stock dividend distributable and replace it with garden variety common stock. Finally, property dividends. A property dividend is the distribution of a non-cash asset to shareholders as a dividend. Now, it's usually used in closely held corporations. It's difficult to use these in widely held corporations. Let's assume let's assume you're megacorp and you've got millions of shareholders. How do you take an asset and divide it amongst millions of different shareholders? So generally it's very seldom used in the case of widely held corporations. Instead, it's used in closely held corporations where the shareholders might be, mom and dad and Uncle Bill, and so it's fairly easy to distribute assets among a small number of shareholders. Sometimes it is used to effect spin-offs of subsidiaries. So for example, if there's a large conglomerate that wishes to divest itself of a certain subsidiary, they can spin it off and give out shares in the subsidiary to their existing shareholders in the form of a dividend. Now, property dividends are accounted for at the fair value of the property that's being distributed. So the first thing we're going to do when we have a property dividend, step one is going to be to write the property up or down to fair value and record a gain or a loss on that revaluation. Step two, we declare the dividend. Step three, we distribute the dividend. So again, let's take a look at an example. Let's assume a firm has an investment in stock which cost $40,000, which has a fair value of $50,000, and they're going to distribute this as a dividend to their shareholders. Again, the first thing we have to do is write the asset, in this case up, to fair value from $40,000 up to $50,000. So we increase the investment account by $10,000, and that appreciation is recorded as a gain on investment. Then we declare the dividend in the usual way. We debit dividends declared for the value of the dividend, credit dividends distributable for the value of what we're going to distribute. And then when we distribute it, again, we satisfy that dividend distributable obligation by surrendering the asset. It's important to note that we only write up the portion of the asset that we intend to distribute. If we were only going to distribute half of our investment, we'd only write up half of the investment's fair value. The portion that's not going to be distributed, we leave that at its historical cost.